So there's a lot of speculation out there that we're in a housing bubble. A lot of people are saying this is just like 2008, and we're seeing home values go way up, but at some point they're going to come crashing down, right? And we're going to experience a real estate market crash. A lot of people are saying 2020, some people are saying 2021. So it's generally in the next 12 to 24 months of when everybody's predicting this big housing market crash. And I'll admit that some of the arguments are interesting to think about, and that we are in completely unprecedented times. We can't simply go back to the last time that we were in this situation to kind of predict what's going to happen in the future. So today I wanted to run through what the actual arguments are for a potential housing market crash. I'm going to just lay all the facts out for you guys, and then I'm going to give you my interpretation of those exact facts and tell you what I personally think is going to happen in the very near future. And I'm going to explain to you why I personally just bought a house last month. So first, before we even get into why people think that there's going to be a housing market crash, let's really evaluate why home values have just started skyrocketing in 2020. And there's really three major causes for this. The first one is going to be that the Federal Reserve lowered their federal funding rate to near zero, almost zero. And this is the rate that the Federal Reserve lends money to the banks so that the banks can then lend money to us, the consumers. So typically when the federal funding rate drops way down, interest rates also drop down as well. It kind of lags behind it by several months, and it does take a little while for interest rates to catch up to that big change in the federal funding rate. And so what we're seeing right now is historically low interest rates on 15-year and 30-year mortgages. Like, they have literally never been this low before. I just bought a home last month. I got a 2.75% interest rate on my 30-year loan. And so in my opinion, this is one of the biggest factors as to why home values are going up so quickly, because we have so many buyers entering the market trying to lock in these low interest rates while they last. A lot of consumers at least, are speculating that this is not going to last very long and that interest rates are going to go back up. So they want to lock in this low interest rate for the next 30 years or so. And what happens when you have a lower interest rate is that if you have a fixed goal for your monthly mortgage payment, you can now afford a more expensive home for the same mortgage payment than you could previously. So I ran some numbers, and about 12 months ago, mortgage interest rates on a 30-year loan were about 4%. And if you wanted to have a $2,000 a month mortgage payment with just the principal and interest, for 4%, you could buy a $420,000 home. And today, mortgage rates are somewhere around 3% for a 30-year mortgage. And so again, if you wanted to only have a $2,000 a month mortgage payment for principal and interest, you can now afford a $475,000 home. So as of today, you can now afford a $55,000 more expensive home than you could for the same monthly mortgage payment as you would have had 12 months ago. And this is the biggest reason why we have so many buyers entering the market right now trying to lock in these low interest rates, and why they're so willing to pay above list price and just throw money at these houses just to lock in one of these rates. Now, another huge factor is the moratorium on foreclosures right now. So when Congress passed the CARES Act, they said that banks are not allowed to foreclose on homes anymore. And I think the original CARES Act had maybe a 2-month moratorium, but what's happened now is each individual state has picked that up and applied that same moratorium to their individual states to extend it. And every state's actually a little bit different. Some states have a specific date of when they're going to cut that off and allow banks to start foreclosing on homes again. And other states like Maryland have tied it to our state of emergency. So here in Maryland, when we lift the state of emergency, that is when the moratorium on foreclosure ends and banks can start foreclosing on homes again. And this is pretty significant. This means that we have fewer sellers in the market because we virtually don't have any short sales or any foreclosures listings in the market. And there's a third factor, and that's simply that a lot of sellers have decided just not to sell right now because of the pandemic. And I personally don't blame them. I would be a little apprehensive about a bunch of strangers walking through my house every single day as well. So because of these three factors, we have a lot of buyers in the market. Because of the moratorium on foreclosures, we have fewer listings, and then a lot of sellers also took their homes off the market. So we have a very imbalanced market right now. And this is causing buyers to put a lot of above list price offers in and causing home values to skyrocket. So this is just a classic supply and demand situation. We have a lot of demand and very low supplies, so we're seeing home values go up. So out of these three factors, two of them are probably going to change in the next 12 to 24 months. One, I would speculate that sometime in the next 12 to 24 months, we're going to get this pandemic under control, maybe have a vaccine, and a lot of the sellers are going to feel much more comfortable about listing their homes again. And that's just my personal prediction. But the second factor that's going to change is that moratorium on foreclosures will come to an end at some point. And let's say that moratorium on foreclosures comes to an end 6 months from now. And so we have a total of about 12 months that the banks were not allowed to foreclose on homes. And this is the biggest argument that people are making for a potential housing market crash. They're saying that, one, we're going to have 12 months of foreclosures all hit the market at the exact same time. But it can be even worse than that because of the high unemployment rate. We're going to see even more foreclosures than we typically do. So we may have not just 12 times as many foreclosures hit the market all at once, we may have 20 times as many foreclosures hit the market all at once. So that is what the argument is, that we're gonna have so many foreclosures that we're gonna get into a unbalanced market, and that we're gonna have far more listings than we do buyers, and then home values are going to drop. And personally, I think that's kind of a ridiculous argument, and I don't see that causing a housing market crash, and here's why. Because just because the bank has, let's say, 12 times as many foreclosures, doesn't mean we're going to see 12 times as many listings. They're not going to hire 12 times as many staff to process all those foreclosures at the same time. The bank is going to be the bottleneck right there, that they can't process that many foreclosures at once. Another factor is that many foreclosures take 2 to 3 years to actually process and actually go through. And many of them don't actually end up with the bank repossessing the home, right? They may work something out with the homeowner. And if a bank has that many foreclosures in their queue, they're going to be incentivized to work something out with the homeowners. Probably going to see a lot more forbearances where the bank kind of forgives the 12 or 24 months of mortgage payments that the homeowner missed and just adds it on to the end of the loan. Or we're going to see a lot of refinances, or we're going to see a lot of maybe interest-only loans for a few years until that homeowner catches up, right? They're going to try to work with the homeowner so that they don't have to process that many listings all at once. And with the foreclosure process, you also have to involve the court system, and that is going to be another major bottleneck. The court system is not going to be able to process 12 times as many foreclosures all of a sudden, or maybe even 20 times as many foreclosures all of a sudden. So personally, my prediction is that yes, we are going to see a lot of foreclosures hit the market. We're going to see a lot more than we typically see. But just because we had 12 months of a moratorium on foreclosures doesn't mean we're going to see 12 months of foreclosure inventory hitting the market as soon as that moratorium is lifted. But we are in such an unbalanced market right now. We have so many more buyers than we do sellers right now. Even if we saw a huge spike in inventory, I don't think that we would ever be able to flip that ratio. I think at best, maybe we could get into a balanced market, right? And a balanced market means you have 6 months of inventory. For a market crash, you would have to have the complete opposite. You'd have to have far more listings than we do buyers. So the big question is, if we see that increase in inventory from foreclosures, are we still gonna have that huge demand from buyers that we have right now? And I think that the answer is going to be absolutely yes. The Federal Reserve has already come out and said that they intend to keep interest rates at near zero for the next 3 to 4 years at least. And when the Federal Reserve first dropped their interest rates to near zero, banks didn't instantly drop their mortgage rates as well. Instead, what they started doing was coming down slowly. And at some point, they actually got so overwhelmed with refinances and purchases that they actually increased interest rates again just to slow down the number of files that they had to process because they could not keep up with the demand. Personally, I think we're going to keep seeing interest rates drop lower and lower for the next year or two. I would not be surprised if 12, 24 months from now, we're seeing interest rates at 2% or even below 2%. And this is going to keep the demand of buyers entering the market extremely high and make it much more affordable for buyers to enter the market as well. And this is why I personally bought a home literally just last month, because I got a fantastic interest rate of 2.75% that I was able to lock in, and I personally intend to live in that home for the next 15, 20 years. So even if home values ever did drop down slightly, I'm not concerned about that. What I'm concerned about is what they'll be at 15, 20 years, and I am very confident that home is gonna be worth a lot more than I paid for it today. So look, if you wanna learn what the 7 steps are to not just survive a recession, but thrive in a recession, check out my video right here breaking those down for you. And if you want to earn 2 completely free stocks, one of which could be valued up to $1,400, use my link in the description below to open up your free account with Webull. Thanks so much for watching, and I'll see you guys over in the next video.